Nobody, I mean nobody, expected this drop in the markets today. We're getting some concerning news out of a financial institution that is causing some fear, uncertainty, and doubt regarding financials, regarding some of your largest banks. And today was actually the largest drop of bank stocks since the crash of 2020. This has a lot of people concerned, and we will get into it here in this video and give you guys the most up-to-date information regarding this. Now, on top of that, you are going to get very important economic data coming out tomorrow, and Jerome Powell basically outlined, hey, if this data comes in hot, if this CPI report comes in hot next week, we're going to increase the pace of rate hikes. That means a 50 basis point rate hike, potentially a 75 basis point rate hike if the markets start to price that in off of this economic data, potentially coming in hotter than expectations. So the work is cut out for us here in this video, guys. We're not going to waste too much time. If you are new to the channel, hit the like button and subscribe to the channel to stay up to date with this information, which could make you a lot of money. So the S&P dropped 1.84% in regular trading, currently down 0.15% in after hours trading. This all really could be boiled down to this one name, SVB. This stock is down 60.5% in regular trading, down 7% in after hours trading. This is a financial institution that does a lot with private lending. They have a lot of different components to their business, but you can think about this as a bank, right? They basically are a bank. Long story short, down almost 70% on the day. And I mean, this stock dropped $161 in regular trading, down about $7 to $8 in after hours. What is happening here is, hold on, let's just explain this showing the bonds. So what essentially this company said is they are going to try to fix their balance sheet by raising about $2 billion in capital, selling their bonds to realize about a $2 billion loss, and to repurchase said bonds with shorter durations. Because essentially what SVB did is, over the last year or two, they have been buying bonds. And this is the face value of a bond. So when you're buying this at $150 in December of 2021, well, the yield, the actual payout stays the same on the bond, right? The only thing that fluctuates is the yield, which and the price. But when the price goes down, that means yields go up. This is essentially a dividend stock, right? Think about this, and this is how bonds work, so you guys can get something out of this forever. If your said bond, just for simple math's sake, is going for $200 and that bond pays out $5 a year, well, that is a 2.5% yield. If now the bond price goes down to $100, now it's paying still $5 a year, but it's paying you 5%. Now, if you are a holder of that bond and you purchased at $200, that's your cost basis. You are forever getting that yield of 2.5% until that bond comes mature, right? Until you'd get your payout back. Well, now your actual value has dropped, call it $100. So if you want to go out to the open market and sell your bond, you're going to sell it for a 50% loss, right? And that is basically what happened with this financial institution. They went out and they bought a bunch of bonds when the bonds were in between, $130, $150. Well, now bond yields have went exponentially higher. The bond prices have fallen a lot to where they currently sit at $102. So meaning they got a very low yield relative to where bonds are now, and their actual equity values dropped exponentially in one of the worst years for the bond market which was 2022, it's dropped a lot. So not only are you getting a small yield when inflation is very high, you've lost money on your actual equity, right? Pretty straightforward. This should make sense to most of you guys. Well, now they have a lot of redemptions, and people are trying to get out of this financial institution. Well, they locked up $30 billion in bonds that they're underwater on. So that's why they have to raise capital. Essentially, the bonds are putting them in a chokehold here. Well, that is why you have other companies like JP Morgan down 5.5% on the day, and other banks down more than that, because people are concerned if this happened with them, how much is it happening with other banks? And you're starting to get some mass panic on Wall Street regarding the banks, something that we have really not seen at all so far since the COVID pandemic. Everyone thought banks were going to take a hard hit. Did not happen. People are thinking it might be around the corner. So that is very interesting. That is the main thing that is causing the markets to move down. Whenever there is instability within the banks, think financial crisis, right? 2008, 2009. People not going to like that. That is a lot of fear on Wall Street, or causing a lot of fear on Wall Street today, I should say. But tomorrow you have very important economic data as well. And this is really going to solidify a lot for the Fed and this next meeting coming February 22nd. And if you take a look at one of these main headlines on CNBC, it says February is expected to have been a strong month for hiring and wage growth. It's not what the markets want to hear the day before the data comes out. Well, if this report is anything like the last report, where we were expecting 200,000 jobs to be added in January to subsequently get 500,000 jobs added in January, if anything like that happens for February, for the data we get tomorrow, it's not going to be pretty. It's going to solidify larger rate hikes to come. That has been the whole investment thesis so far in 2023, is investors, we should buy equities because the Fed is going to slow down and pause after this March meeting. That was the consensus before this bad data, before the Fed speech earlier this week. Well, now it looks like none of that is true. Now it looks like inflation might be going higher. The Fed's going to raise rates at a more aggressive pace than we thought. And maybe the banks could become, to a certain degree, insolvent. Not good. Not good. So that's what is happening today. That's the easiest way to boil it down. Now, the economic data coming out tomorrow is going to be very, very important. And it's probably going to cause a 2 to 3% pop or drop across the indexes. It's going to be that important. Now, next week as well, you're going to have the CPI that comes out. And couple that with this data that we get tomorrow, that's where you're going to get the pricing in of the March 22nd rate hike. So non-farm payrolls for tomorrow, for February, we're expecting 210,000. The consensus is around 200,000, or it was for January. It came in at 517,000. You do not want to see a replay of January. It's not going to be taken so well this time around. Let me tell you that. So anything I would say that's over like 250, probably going to give you a 1% drop. 250,000 jobs added. If it's over 350,000 jobs added, you're probably getting a 2% down day. If it's 500,000 or higher, again, yeah, you're probably down 3.5–4% tomorrow. To the contrary, if you get 100,000 jobs added, you're probably up 2% tomorrow. If you get 50,000 jobs added tomorrow, you're probably up 3.5% tomorrow. So that's kind of the way that I like to look at this. If it comes in on expectations, you might get a up or down 0.5% day. Because after all, those are the expectations. Now, for the unemployment rate coming out tomorrow, I don't think this is going to move as much. Certainly, if it goes down from 3.4% to 3.3%, not going to be a good thing. If it goes up to 3.5%, really doesn't matter. That's where we were at 2 months ago, right? So I don't think the unemployment rate is going to be as important, but the average hourly earnings, that is going to be key for tomorrow as well. Year over year, you're expecting a gain of about 4.7% from last month's year over year reading of 4.4%. So going up year over year, pretty decent right there. Not such a good thing. And then average hourly earnings month over month went up 0.3%. That was the January number. You're expecting another 0.3% increase. Pretty much in line with what we've seen month over month every month over the past year. This is really not, anything new to see average hourly earnings go up 0.3% month over month. That's basically what we've been at if you take a look at this chart. Basically, yeah, it comes in 0.3 to 0.5% every month since the last year. With that being said, this day and age right now, where we are in the markets, they might not like that as much. And continuing on, it's going to be more and more important. And then ultimately CPI coming out next Tuesday at 8:30 in the morning, that's going to be big. And we don't have any estimates as of right now necessarily for the core inflation rate. For the inflation rate year over year, you are expecting 6.2% from last month's reading of 6.4%. And the inflation rate month over month, you are expecting a 0.4% increase. So slowing down a little bit from last month's 0.5% increase. And as you can see, this is how important this actually is. Do you continue to go higher after, falling for so long with CPI, with inflation, or do you continue to fall? And that's ultimately what is going to drive this market. You guys can see the probability of a 50 basis point rate hike actually went down from 77.1% yesterday to 6.4% here today. Not necessarily a good thing in light of financial fears, right? If the financials really started to take a massive hit, like JP Morgan, right? Goldman, Morgan Stanley, if these banks started to fall, the Fed might have to step in and help them out. And that's kind of what this is pricing in. If all of a sudden you start to price in that 25 basis point rate hike, it might actually show a lot more fear than not for the markets. All of this really going to ride on tomorrow's data. If tomorrow's data gives you that really negative response, guys, you did close today. Go ahead and show you above the 200-day moving average, but under the 100-day moving average. You fell under the 50 and the 100-day moving average today. Not quite getting a close under the 200-day moving average. That is at 391.12. You're at 391.56. If you break under that 200-day moving average, it could spell a lot more downside, like you've seen even back here in November of 2022. You broke under that and fell all the way, back down to the 360 range. And even before then, you had fallen to 346, the low of 2022. So you're at a very critical level here in the markets. Let me know what you guys think about all of this information down below in the comment section. What do you think is going to happen with tomorrow's data, and where ultimately do you think the markets are going from here? So that is it. You guys enjoy the rest of your day, and I will see you in the next one.